If you are watching this and you have recently lost your spouse or your spouse is struggling in this moment, please know that my heart goes out to you. On top of all of the emotions and the logistical chaos that you'll experience, there are 6 things that I want to warn you about when it comes to your finances that many don't know about or they overlook when a spouse passes away. The first is the most malicious, and that is that you become a target for scammers. I have not lost my wife, but I did go through the passing of my mom a little over a year ago. There are the funeral arrangements, there are the bank accounts, there are the retirement accounts, the house, the car, the belongings, the memories, and the grief. Everything is swirling around at 1,000,000 miles an hour, so the fact that there are people out there who will search for the names and addresses of widows or widowers in probate documents and obituaries makes me question humanity. But it's a real thing that you're going to need to be prepared to deal with. These criminals reach out by phone, text, email, or mail in your mailbox. It is usually disguised to look like some official correspondence from the government organization like Social Security. The phone calls and texts will be someone pretending to be from Social Security and asking you for personal information so they can ensure that your payments are not stopped. It could be somebody pretending to be from the life insurance company claiming that in order to collect on your spouse's life insurance policy, you need to make one more premium payment. Another common tactic is to claim that your spouse owed a debt that hasn't been repaid. Finally, romance scammers prey on those who have recently lost a spouse. Because of the high emotional stress and the complexities of this time of life, it makes widows and widowers easier targets. If you get a text message or something that seems like it's real, call whatever companies you use for your mortgages, your life insurance, or your banking information directly from the number on your account statements, not the numbers that people leave in your voicemail, email, or text. If all you have is a will for your estate plan, wills are made public once they enter into the probate court. If you have a home, a trust is private, and it may be something that you want to consider here just as a general suggestion, but it could also help with those criminals who are patrolling the probate courts for their victims. So please be careful, screen your calls, be careful of any solicitors who are asking about your personal information or money or investment opportunities. You can freeze your credit accounts at the 3 main credit bureaus of Equifax, Experian, and TransUnion, which leads me to point number 2. Your credit score could go down. If you and your spouse were using a joint credit card or cards, one of you is probably the primary account holder and the other is an authorized user. When the bank learns of a primary card holder's death, the bank will typically close that account. So if your spouse was the primary card holder on these accounts, closing those lines of credit can lower your credit score. Ohio State University did a study around this effect, and it found that there is a drop on average of about 10 points to a recently widowed spouse's credit score. But the even bigger threat to your credit would come from late or missed payments. If your spouse was the one who handled all of the bills for your family, this can get a bit tricky. Many couples do not keep organized records of their accounts, their logins, their passwords, and how these bills are paid with due dates. If you are watching this and you and your spouse are in good health, please have a proactive conversation with each other about your family's financial information, including those account numbers, passwords, debt payments, due dates, and account balances. My wife and I use a password manager where I've got it all organized by my passwords, her passwords, the family passwords that include the kids, and our health information. In my marriage, I handle all of the finances for our family, and I keep a spreadsheet of all of our assets like the cars, the home, retirement accounts, investment accounts, business accounts, life insurance policies, and bank accounts for all of us. I update this about every 3 months or so with the balances in these accounts and the amounts owed on the house, any debt we have, and the debt payment dates. My wife hates having these conversations. She doesn't like entertaining the idea of me dying, and I don't like it either, but we take about 15 minutes every 3 months, and I go over this snapshot of our financial life and remind her that if I were to die, here is where the things are, and here is who I would want her to call, our financial advisor and a good friend of ours who is an attorney. Please be proactive, not reactive when it comes to your payments and your obligations. If the unthinkable has already happened, pay close attention to your mail, and if you can log into your spouse's email accounts or their phone, be sure to keep an eye out if there are any bills or notices that you may be receiving. Again, call the numbers on the statements. Do not call the numbers of unsolicited texts or phone calls. So your credit score may go down, but at number 3, we have your taxes will likely go up. You will likely face what is referred to as the widow's penalty, which is paying a higher tax rate. The reason for this is that once you lose your spouse, you will be filing taxes as a single filer rather than a joint filer. Single filers have a less advantageous tax bracket situation than those who file jointly. For example, if you make $75,000 in taxable income and you file jointly, you'd find yourself in the 12% federal tax bracket this year. But if you were to file as a single filer with this same income, you end up in the 22% tax bracket. Not only that, your standard deduction is now cut in half as a single filer versus a joint filer. This year, the standard deduction for married couples filing jointly is $30,000, but for single filers, it's just $15,000. Both of these numbers are slightly higher for those who are 65 and older. There are a couple of notable details to keep in mind. First, in the tax year that your spouse passes away, you are still able to file taxes as joint. So this hit isn't as impactful in the year of the passing, but subsequent tax years are impacted. Also, if you have minor dependents, you have a 2-year window where you can continue to file at joint rates. Finally, if you are taking care of an older or disabled relative, you may be able to file your taxes as head of household, which is more favorable from a tax perspective than single, but not as much as filing jointly. I highly recommend working with a tax advisor or financial professional after the death of a spouse. I mentioned it with my plans with my wife. We have a financial advisor who she knows well and who I trust to take care of her financial strategies and making tax efficient decisions for my family should I pass away. There may be opportunities for Roth conversions during that tax year where you are able to file jointly, which is again, why having a financial helper here as you are dealing with all of these other things going on is, in my opinion, a good idea. The fourth thing to be aware of is also related to taxes, but it has to do with the sale of your home. When you sell a jointly owned home as a couple, you get to exclude up to $500,000 in gains on the sale of that home, meaning you aren't taxed on those gains. When your spouse passes away, you have a 2-year window to sell that home to use that $500,000 exclusion. You and your spouse must have owned and lived in that home for 2 out of the last 5 years before this death to take advantage of this opportunity. After this 2-year window, you are only allowed to apply your half of that exclusion, so $250,000 if you sell that home after 2 years. At this point, only half of your home value will get that step up in basis after your spouse's death, which we cover in our estate planning video specific to real estate assets that looks like this. Taxes are just one thing to keep in mind when it comes to where you ultimately decide to live, and frankly, not the most important, but they are still a consideration to have. There are other factors, including the cost and the stress of moving, living where so many memories took place, and others. But if you are considering downsizing your home, moving closer to family or support, or relocating to build a new life, there are planning steps that you can take that will put you in a more beneficial financial situation. Only 2 more to go here. The 5th financial consideration is applicable to those who are collecting Social Security income. When you lose a spouse, you will likely see a decrease in your household's Social Security income. When somebody who is collecting Social Security payments dies, their benefits stop. So if you were collecting both Social Security payments from you and your spouse, one of those is going to end. There are exceptions here, but a common setup is that one spouse has a higher Social Security amount while the other spouse can take spousal benefits, meaning that they are collecting up to half of the higher earner's benefits, essentially giving the couple 150% of the higher earner's Social Security benefits. There's a lot more nuance to this, which we cover in a video that looks like this, but the point is that if there are higher earning spouses who pass away, the surviving spouse may be eligible for up to 100% of the deceased spouse's benefit, which is great, but it is still less than 150% of that spouse's benefit that they were living on previously. If you are the higher earning spouse, then you maintain your benefit, but you lose the Social Security income from your spouse who has passed away. The Social Security Administration is notorious for giving different answers and not providing you with actual strategy around what you and your spouse can do here. So you may need to call multiple times to make sure you're getting consistent information. And then I would work with an advisor who understands the different Social Security strategies that can help you in this moment. If you are watching this and you and your spouse are still alive, work with an advisor who is good at this Social Security conversation to go over the options of when each of you should be taking your benefits to maximize your dollars, not just now, but in the event that one of you passes away first. Okay, the last financial warning that I have for those of you who have lost a spouse recently or you may lose one soon is to caution you against spending your money as a coping mechanism. Retail therapy is the phrase given to those who spend money to deal with stress or depression, and when someone passes, those emotions are more than happening. I'm not here to tell you how to grieve. I'm just here to warn you against using your funds in a way that will put your future self in trouble. Again, for anyone going through this, my heart goes out to you. Several of these touch on taxes and Social Security. So click on this video right here to watch a discussion that I have with Zach Call about when to take Social Security. I will see you over there.